And we've got, well, one of the densest financial documents of the year in front of us.
Oh, absolutely.
The JPMorgan Chase & Co. earnings release financial supplement for the fourth quarter and full year 2025. This isn't just a scorecard, is it?
Not at all. It's more like a map. It shows you exactly where the biggest strategic bets were placed and, maybe more importantly, where the risks are pooling.
That's a great way to put it.
And that's our mission today, right? To cut through the noise, get past the big headlines, and really analyze how the core business segments performed.
The big three.
The big three: consumer and community banking, the commercial investment bank, and asset and wealth management. And crucially, we have to pinpoint how these major strategic moves, especially around credit portfolios, immediately change the firm's financial health.
And their capital cushion.
And their capital cushion at the end of the year. That's key.
Okay, so to navigate this, we'll be keeping a few key comparisons in mind. We have the quarterly moves, Q4 25 versus Q3, and Q4 25 versus the year before. And then the big picture, the full year 2025 versus 2024. So let's start at the top, the consolidated view for 2025.
Sounds good. So from a high level, the full year results look pretty solid. They show steady expansion. Total net revenue on a managed basis came in at $185.581 billion.
And that's a solid 3% increase over the previous year.
It is.
But right away, the numbers throw a bit of a puzzle at us, because despite that 3% revenue growth, net income for the full year actually went down slightly.
Right. It clocked in at $57.048 billion. Which is down 2% year over year.
So how does it happen? How do you grow revenue but shrink your profit?
It's all about context. You have to look very closely at the comparison year 2024. That year was, let's say, artificially inflated by a massive one-time gain.
The Visa shares.
Exactly. In 2024, they booked a $7.9 billion net gain related to the firm's Visa shares.
So when you're trying to compare the real operational strength of the 2 years, you have to sort of mentally subtract that massive windfall from 2024.
You have to. That gain was booked mostly in the corporate segment, which, explains why that segment's revenue shows a shocking 60% year-over-year drop.
60%.
Yeah. So when you look at the core operating businesses, 2025 was actually substantially stronger because the profit came from sustained activity, not a one-off sale. The underlying profitability was very robust.
Okay, that makes sense. What about the cost of running that bigger business? Non-interest expenses are always a key metric.
They grew, but I'd say responsibly. Total non-interest expense was up 4% for the year, hitting $95.640 billion.
So a little higher than revenue growth.
A little higher, which suggests, continued investment in things like technology and infrastructure, which we'll see later when we get into the segments.
All right, let's shift to the foundation capital, because this is where we see the first real immediate impact of their year-end strategy, the CET1 capital ratio.
Common Equity Tier 1.
Right. It dropped pretty significantly from 15.7% at the end of 2024 down to 14.5% at the end of 2025. For anyone listening, can you just remind us why that ratio matters so much?
Well, the CET1 ratio is maybe the most critical metric for a bank this size. It's the bank's core measure of safety.
It's cushion.
It's cushion, exactly. The ratio of its highest quality capital against its risk-weighted assets. A drop from 15.7 down to 14.5 means the bank has less of that cushion relative to the loans it holds. It shrinks its capacity to absorb losses.
So a drop like that is a loud signal.
A very loud signal that something big and balance sheet heavy happened right there in Q4.
Which is a perfect lead-in to our next section, because that event is just all over the credit risk numbers. Let's look at the provision for credit losses. This line item just jumps off the page for the full year, up 33% over 2024, reaching $14.212 billion.
And if the annual jump is noteworthy, the quarterly jump is truly dramatic. The provision for credit losses hit $4.655 billion in Q4 alone.
Just here.
Just in Q4. That's a 37% sequential increase from Q3 and a staggering 77% higher than Q4 of the previous year.
Let's clarify this for our listeners. Provision for credit losses means they're setting money aside now for losses they expect in the future.
Right. That's the critical distinction. The provision is an expense on the income statement. It's management's estimate of future risk. Net charge-offs, on the other hand, are the actual losses they've already realized.
So when the provision spikes like this,
it signals management sees something coming, either a worsening economy or, in this case, a massive new portfolio of loans that requires immediate reserving.
And the document is crystal clear about what drove this Q4 spike.
Oh, there's no ambiguity. This huge Q4 provision includes a specific $2.2 billion increase strictly for lending-related commitments associated with the, and I'm quoting here, forward purchase commitment of the Apple credit card portfolio.
And the timing on that.
December 30, 2025.
Yeah.
Right at the very end of the year.
So the ink barely dried on that commitment, and boom, the bank immediately had to expense $2.2 billion in the fourth quarter.
Instantly. That single item accounts for roughly half of the entire quarter's provision for credit losses. It's a huge strategic cost to absorb all at once.
And it didn't just hit the income statement. You said it hit their capital.
It did. It directly impacted those capital ratios we just talked about. The document specifically notes that this forward commitment led to an estimated decrease of about 25 basis points in that CET1 ratio.
And 25 basis points is 0.25%. That's a huge bite out of the capital cushion from just one single commitment. The report mentions the Basel III standardized approach here. What does that tell us?
So Basel III is the global regulatory framework. The standardized approach is one way banks calculate their risk-weighted assets, and it often requires higher capital for certain loans, like consumer credit.
Like credit cards.
Exactly. By specifying that, the firm is signaling that this Apple portfolio requires a significant capital allocation based on its risk profile. It was a costly bet, both in terms of income and capital.
So beyond that huge strategic charge, what does the rest of the consumer credit data tell us about the health of the American consumer? Are things getting worse?
I would say they're normalizing, which does mean rising. Total net charge-offs in CCB rose 4% for the full year to $8.247 billion. And if you look just at card services, the net charge-off rate was 3.31% for the year.
Okay.
And non-accrual loans, those loans past due and not expected to be paid, were up 4%. So, yes, the underlying trend is upward credit risk, but the Apple deal just completely overshadowed everything else in that Q4 number.
So if the consumer segment was facing headwinds and that massive cost, let's pivot to the growth engines. Where was the good news?
The story of 2025 profitability is really dominated by the fee-generating businesses.
Right.
When you look at managed net income for the full year, the star performer in terms of growth rate was asset and wealth management. Net income there grew 20% to $6.522 billion.
20% is huge.
It's massive. And right behind it was the powerhouse, the commercial and investment bank, which grew net income by 12% to an incredible $27.761 billion. CCB, despite the challenges, was still resilient, growing 4%.
That CIB growth is just enormous, almost $28 billion in net income. What was driving that 12% revenue increase there?
It was almost entirely fueled by market dynamism. High trading volumes, a lot of activity. We saw fantastic growth in markets revenue overall. Specifically, equity markets revenue was incredibly powerful, up 33% for the full year. And fixed income markets revenue rose a solid 12%.
What about investment banking fees?
Also contributed. They were up 7% overall, driven by strong debt underwriting, which climbed 9%, and advisory services, up 6%.
So markets were a huge tailwind. But the CIB also takes on commercial risk. And wait, I see a concerning number here. CIB net charge-offs, a massive increase of 119% year over year.
Yes, totaling $1.509 billion.
That's a dramatic spike in realized commercial credit losses. Is this just normalization after a period of super low defaults, or is this a real warning sign hidden under all that trading revenue?
That is exactly the right question to ask. A 119% spike should absolutely get your attention. While trading revenue is great, this spike in commercial charge-offs reflects volatility in some specific corporate loan books.
So it's concentrated.
It tends to be lumpy, more so than consumer credit. So while it's concerning, it likely reflects a normalization of risk after some aggressive lending earlier in the cycle. It highlights the risk that comes with that 21% growth in CIB loans we saw.
Especially that 82% increase in loans held for sale.
Precisely. High growth in risk assets often means absorbing higher realized losses down the line.
Okay, so let's swing back to the consumer side, but let's exclude the Apple noise. We saw CCB net income still grew 4%. Where did they find that resilience?
They found it in scale and digital dominance. The card services and auto revenue segment grew a really healthy 11% for the year.
And their digital scale is just unmatched.
It is. Active digital customers hit 74.6 million, up 5%. And active mobile customers, 61.7 million, that's up 7%.
And that digital footprint, it just translates into massive transaction flow.
It really does. Total payments transaction volume across the whole firm was $7 trillion.
$7 trillion.
Trillion. Up 9%. It's a gargantuan amount of money. And while they dominate digitally, they're also still investing in their physical footprint. The number of branches actually went up 2% to over 5,000 locations.
Interesting.
And one other bright spot was their mortgage business. It showed a strong recovery, with origination volume growing 29% in 2025.
Wow. Okay, finally, let's look at asset and wealth management. You said it had the best growth rate, 20% in net income. What fueled that?
Two things: market appreciation and just really successful client acquisition. Total client assets soared to $7.118 trillion.
Just think about the sheer scale of that number.
It's hard to even comprehend. $7.1 trillion under management. That's like combining the GDPs of two major European nations, all flowing through one division. And assets under management specifically were up 18% to almost $4.8 trillion.
That is just mind-boggling growth. Where was it concentrated?
It was pretty broadly distributed, which is a good sign. It benefited from strong market performance, especially in stocks. Equity assets grew 24% year over year, and liquidity assets grew 18%, which tells you clients are not only seeing gains, but are also comfortable keeping large cash balances with the firm. And to manage all that, they hired more people. The number of private bank client advisors went up 9%.
Okay, so CIB thrived on market activity, CCB drove volume, and AWM just captured massive market gains in client assets. We've covered the income statement. Let's wrap up by looking at the broader balance sheet and capital deployment.
The balance sheet clearly signals confidence and ongoing expansion. Total loans across the firm were up 11% for the year, hitting almost $1.5 trillion.
And deposits.
Deposits increased a healthy 6% to $2.559 trillion.
I found a fascinating detail in those deposit trends. It looks like a major institutional shift. While U.S. deposits were pretty stable, non-U.S., non-interest-bearing deposits shot up 38% year over year.
Yeah, that is not noise. That's a significant, deliberate shift.
What does it tell you?
A 38% rise in non-U.S. deposits, especially ones that don't earn interest, suggests major institutional clients overseas are moving substantial cash into the firm. They're valuing the perceived safety and global payment network of the bank over earning any interest income.
So they're parking cash.
Parking huge amounts of cash. It suggests the bank is capturing unique risk management or treasury opportunities abroad.
Let's touch quickly on the interest rate environment. How did that play out?
Well, the full-year average rate on their loans was 6.72%, so solid lending profitability. And the net yield on all their interest-earning assets for the year was 2.50%. But late in the year, we started to see some rate compression. The interest rate spread in Q4 was only slightly higher than the year before, which suggests that the cost of funding those deposits is starting to creep up on the yield they're making from loans.
Okay, last thing. We need to talk about capital deployment because it was incredibly aggressive in 2025. Isn't repurchasing over $31 billion in stock a 68% increase? While your capital ratios are dropping, isn't that a deliberate trade-off?
It's absolutely a deliberate trade-off. It's a critical observation about their capital strategy.
So are they prioritizing short-term earnings per share over their regulatory cushion?
I think they're aggressively focused on returning capital to shareholders, yes.
Yeah.
They repurchased $31.640 billion in common stock. That directly contributed to the 4% reduction in shares outstanding.
Which is how EPS went up.
Exactly. That's how diluted earnings per share ticked up 1%, even though net income was slightly down. They're clearly signaling confidence in their ability to generate capital internally, even if it means running closer to the middle of their target capital range for a while. And that new, massive $50 billion repurchase authorization tells you everything.
The message is clear.
The message is prioritize shareholder returns.
So what does this all mean for you, the listener? We started by saying the consolidated view was a bit opaque, but once you drill down, 2025 was really defined by two powerful, contrasting narratives.
Absolutely. The dominant operational story is the robust, double-digit growth of their core fee-generating machines, AWM and the CIB. That's excellent, sustained momentum.
And the other narrative?
The countervailing narrative is the immediate strategic absorption of risk and capital related to that $2.2 billion provision for the Apple credit card portfolio. It was a year where incredible operational success provided the capital to finance a significant strategic pivot toward deeper consumer lending exposure.
Which sets the stage perfectly for the future. And it leaves a big question. Given that massive upfront investment in the Apple Card portfolio and that concurrent deliberate increase in the provision for credit losses to account for it, and the drop in CET1 that followed, how will that strategic investment reshape the consumer and community banking segment's risk profile and ultimately its revenue contribution in 2026? That's the question you should be analyzing as this new portfolio gets integrated into the firm.